Traders University, and it's so good to be with you here on this wonderful Saturday, October 14th, 2023. We're going to start Bulls versus Bears Weekly Forex Forecast, and it's so good to be with you here. And we'll go ahead and get started in just a couple of minutes. Make sure that we have all our systems working. I'm going to turn my camera on. And there you go. How you doing, guys? Again, Dr. Greg McLeod here for Elite Traders University. Let's get to it. It's time for Bulls versus Bears Weekly Forex Forecast. I want to thank you so much for all the well wishes, all the birthday wishes. My birthday was October 12th, and lots of outpouring on Facebook and Twitter and Instagram. So I'm so glad that you guys celebrate with me. Okay, so let's get to it. We've got some inflation data. We got retail sales data. We got a chock full. This calendar economically this week is going to be chock full of stuff that can create a lot of volatility and a lot of trading opportunities in the market. So let's get to it. I'm going to share my screen with you. So make sure that you can see what's going on screen number one. We'll share the screen and welcome, boys and girls, folks and folkaroons. This is Bulls versus Bears, the Weekly Forex Forecast. Again, my name is Dr. Greg McLeod. So good to be with you here today on this wonderful Saturday, October 14th, 2023. Let me direct your attention to risk disclosure on your screen to make sure you understand all the risks associated with foreign exchange trading. And I'm a 28-year, almost 30-year trading veteran. And I'm a Wall Street insider. I've traded everything from stocks, bonds, futures, and crypto. I'm one of the foremost authority on short-term day trading called scalping. And we flip gold, we flip oil, we flip commodities, and we also flip currencies as well. I worked as a currency analyst at one of the largest forex broker dealers in the world, and I've graduated from UCLA. I have a PhD in Christian business and leadership, and I worked at prop trading firms, and I'm a published author. And so I'm uniquely qualified to train people in trading forex or any other asset. I have a proprietary system that I've developed while working for a Wall Street firm. And so we've been using that to help our clients make double-digit gains for several years now. So if you're ever interested, you can always find out more at elitetradersuniversity.com if you choose to. You can find out more and see if it's something that's for you. Okay, moving right along. Let's get to it. We're going to talk about the dollar index, the euro, the pound, the Aussie dollar, dollar yen, dollar CAD, gold, silver, oil, S&P 500. But we're going to first of all start with the economic calendar, and we'll start with that. And let's go back over here. Boom. Okay. And close that up. And we'll close this up and get right to the economic calendar. All right, here we go. So we go to my market heat map. This is my my Swiss Army knife, so to speak. It's my go-to. So hopping around to different websites, looking for information. I have it all at my fingertips with my market heat map. My market heat map is an arrangement of currency pairs by percentage change. It tells me what's hopping, what's popping, what's dropping, and what's not in the currency market. We're having a sale right now, but if you just want to, you can choose to look at that later on. But during market hours, these tiles will flash colors and will move. And green is an uptrend, red's a downtrend, and gray stay away. Right now, it's gray because it's Saturday and the markets are closed. Okay. But also, you can also check out the economic calendar. If you don't want a subscription, you can actually get access to some of these tools for free. You just have to probably reload. And when you reload it, you'll be able to see the economic calendar, right? There's also an introductory video that tells you about the Forex heat map, why this is my top secret tool for generating lots and lots of money in the currency market and any other market too. So let's go ahead and go to the economic calendar. I have it opened up. I already logged in. And so let's get to Monday. We're going to start with 8:30 a.m. Eastern time. I'm only looking at the high probability or the high impact news items. Those items provide the most the most volatility in the market, and they cause the various currencies to move. Remember, as a currency trader or any type of trader, we're looking for movement, for volatility. And so these news items are like a rock hitting the water, creating that activity which we can trade. So up first is at 8:30 a.m. Eastern time, we have the New York Empire State Manufacturing Index. Previous number was 1.9. We're looking for a drop to -7. Now, you got to understand, and we're interpreting the news right now during this time period, it seems that good news for the economy is bad news for the stock market. Okay. And I'll explain about that a little bit later. And also, if we have good news for the economy, again, it will be bad for the dollar. And if it's bad for the economy, we've seen the dollar rally, right? Or actually, good news for the economy causes the dollar to rally and to increase, causes the stock market to sell off. So it's kind of topsy-turvy, and I'll show you why. After that, we're going to have at 5:45 p.m. is we're going to have the New Zealand CPI, or Consumer Price Index, and looking for a rise from 12.31 to 12.57. Higher inflation could push the Kiwi dollar higher, but it's 5:45 p.m. You really don't want to be in the market until after maybe like 6 or 7, more like 7 p.m. Eastern time. So you probably don't want to trade this, but you might want to look at the New Zealand dollar just to see if the announcement carries on for the next couple of hours. 8:30 p.m. we're going to have the RBA, or which stands for the Reserve Bank of Australia, meeting minutes, and the minutes are just telling us what the central bank, what they decide, why they kept rates unchanged at 4.1%, and what is the outlook moving forward. And sometimes you'll see some great volatility come out for the Australian dollar when those minutes are released. Okay, moving on to October 17th at 2 a.m. Eastern time, if you're up. We have some UK data. We have claimant count change, which is their unemployment number. They call it claimants. And we see that the number of people that's receiving aid for losing their job or being laid off is going to rise from 0.9 to 22,000. That could be bullish for the UK stock market, but bearish for the pound, right? So claimant count change, a rise in the claimant count means that actually it would be bullish for the stock market, right? Because the same thing is happening over there as well. If you have strong economic numbers, it means that they have to keep hiking rates. If they keep hiking rates, that's going to be very bad for the stock market. The stock market rallies when there's lower rates. So also Tuesday, October 17th, we have unemployment rate supposed to remain unchanged at 4.3%. 5 a.m. we're going to have the ZEW Economic Sentiment Index, supposed to actually increase from a -11.4 to -9. Then we have at 8:30 the same day, we have U.S. retail sales, our first U.S. Actually the second U.S. data point, because we had Empire State beforehand. Retail sales month on month is supposed to drop from 0.6 to 0.3. That can be bullish for the stock market. Remember, I told you negative news for the economy is usually good news for the stock market and bad news for the dollar. Retail sales year on year is supposed to drop from 2.5% to 1.5%. And then we'll have a whole lot of Canada news, right? Canadian news from news out of Canada, right? We have CPI trim mean year on year, 3.9% unchanged. We have also CPI median year on year, 4.1% unchanged. Inflation rate year on year is supposed to be unchanged at 4%. Kind of boring, right? Inflation rate month on month, not MOM stands for month on month, not MOM. Supposed to drop from 0.4% to 0.1%. Core inflation rate unchanged at 3.3%. And core inflation rate month on month is supposed to actually rise from 0.1% to 0.3%. And that should be noted because it's core, so it's minus food and energy. So it's saying that stubborn inflation is moving through the economy. And so you might see Canada have to do another rate hike in order to fight inflation, which could be bullish for the Canadian dollar for the short term. Even though it's really hard for the Canadian dollar to rally, unless it's doing it against the yen or against the Swiss franc, it's probably not going to do anything against the dollar. At 10 p.m., we have Chinese news. And you're probably saying, well, Greg, we don't trade Chinese news. Why are we looking at it right now? And China is the largest trading partner of two currencies that we do trade, the New Zealand dollar and the Australian dollar. New Zealand and Australia have China as their largest trading partner. So when we see the Chinese economy rallying or getting stronger, we can look at the Australian dollar and the New Zealand dollar as a proxy or a substitute that we can trade, just like it was the Chinese renminbi or yuan, it's called, their currency. So we see the GDP growth rate year on year is supposed to actually drop from 6.3 to 4.4%. That's a huge drop for the second largest economy in the world. And that could be very disastrous for the Australian dollar, or very good for the bears, but not be a very good, not bullish sign. So 10 p.m., you might want to put Australian dollar on your watch list for a possible bearish move. Again, these are not recommendations. Do your own homework. This is for educational purposes only, okay? Also, we have Chinese retail sales year on year, supposed to drop slightly from 4.6% to 4.5%. Again, negative news would be bearish for the Australian dollar and New Zealand dollar. Industrial production year on year is supposed to drop from 4.5% to 4.3%. Again, that will also be bearish for the Australian dollar and New Zealand dollar. We can check the charts to see if people are already positioning ahead of this news. They don't wait till the news to start moving. They start moving this stuff days in advance, and you can start, an elephant can't walk in the sand and not leave a footprint. So we're going to be looking at the footprints in the sand and seeing where the big money is. Follow the money, right? Wednesday, October 18th, we start 2 a.m. with UK data. We have inflation rate year on year. It's supposed to drop from 6.7% to 6.5%. Year on year, but the core inflation rate year on year is supposed to drop from 6.2 to 6%. Inflation rate month on month is really the one that most economists are looking at, because that really impacts where we live. Year on year is a little bit too longer time frame, but you would go month on month. That really hits people in their pocketbooks, and we see it's actually rising from 0.3% to 0.4% month on month inflation rate in the UK. And we also see core inflation rate go from 0.1% to 0.3%. And with oil rising, we see inflation, food and oil, a lot of food coming out of Ukraine and Russia, wheat and vegetables and shortages and things like that have driven up the prices of basic things that people need. And that is contributing to this inflation. The geopolitical instability, war in the Middle East, impacting that as well. 3 a.m. on Wednesday, October 18th, we have CPI final. We're looking at an increase from 124.03 to 124.4. Again, that's the final for the quarter. Inflation rate year on year final supposed to drop from actually 5.2% to 4.3%. So you can see that there's a trend that year on year numbers are dropping. We're comparing this year to last year around this time. However, within the shorter time frame, we're seeing rises in inflation. But let's see, the Eurozone inflation rate month on month final actually dropped from 0.5% to 0.3%. And we have core inflation rate year on year final drop from 5.3% to 4.5%. Seems like the Eurozone is doing a little bit better. And then there's probably no need to hike rates, or a very low impetus for them to hike, which means that the euro might still be in a downtrend, and we'll check that out when we get into the technicals, okay? Again, I told you we have the calendar is chock full of stuff here. 8:30, we're going to have 8:30 p.m. We have Australia employment change supposed to drop from 64.9 thousand jobs to 15,000 jobs. Huge drop there. And we also see the employment rate stay unchanged at 3.7%. Full-time employment change, there's no forecast given. Previous number is 2.8. Participation rate supposed to remain high at 67%, unchanged. Part-time employment change, 62.1 thousand, no forecast given. And then 8:30 on Thursday, October 19th. Happy birthday to my friend Monty. Also, happy birthday to Walter. Happy birthday to Hal. These are some of the guys some of the fellow Libras in the in mentorship who have birthdays in October as well. Okay. And oh yeah, and of course, James. So we have and Arnie. Forget Arnie. It's like is everyone in? No, those are other people, right? So initial jobless claims, 8:30 a.m. Thursday, October 19th. 209,000 jobs. The jobless claim is supposed to rise to 213,000. This is what the Fed wants to see. They want to see more people unemployed. And because if they are, then they can't buy stuff. And if they can't buy stuff, prices fall. That's how they fight inflation, guys. Pretty smart plan, huh? Seems like somebody would find a different plan. I don't think the plan is very good, especially for these 213,000 people who are looking for jobs. They would like to buy stuff too, and they don't care if prices go up or not. Fed Chair Powell is actually he's going to be speaking. He's going to follow up and gloat at how great these hiking rates are impacting. That so many people have to lose their jobs in order for inflation to drop. The needs of the many outweigh the needs of the few. This sounds like a Star Trek thing, all right? Anyway, Friday, October 20th, 2 a.m. retail sales month on month. We're seeing a drop from 0.4% to negative 0.1% in the UK. And the retail sales year on year is supposed to actually rise from a negative 1.4% to zero. Okay. So that's all the news for this week. Again, the big highlights are going to be retail sales and inflation, as well as jobless claims. Okay. So that's what we're going to be looking at trading. So let's take a look at our first chart. First chart I want to take a look at is the US dollar index, and the ticker symbol is DXY. They call it the Dixie. Okay. And so we can see that and I'm using a 20-period exponential moving average. And we can see as long as we're above the 20-period exponential moving average, we've got a bullish move. If we get below the 20-period moving average, we got a bearish move. And you can see after moving sideways for most of 2023, we had a breakout on August 21st. And we can see that we are trading strongly above this 20-week. There's a 20-week moving average, 20-week exponential moving average, right? So we get this 20-week, we're really far above it. And the dollar, bulls versus bears, the dollar is strong, large, and in charge. We can drop down to a daily, and we can see we just bounced off that. Now it's a 20-day moving average, nice bounce higher, right? And so that's what, so DXY is the same as USD, okay? So if you see AUDUSD, it's really AUDDXY or EURDXY, okay? So let me go ahead, and why they use a different ticker symbol or whatever, we don't know. Trying to keep people confused, I guess. But we're going to look at the euro, EURUSD. That's the assortment of confederation of countries that trade with the same currency unit. We used to have separate currencies back in the day: Italian lira and the French franc. And you had the Spanish peseta. You had all these different currencies, and now they're all using the same currency. So it's like the United States of Europe, right? And the German mark was one of those currencies as well. But now they all use the euro, those countries. In fact, Germany is one of the largest economies in Germany, Italy, and France are the largest countries in the Eurozone, and they make up a large portion of the GDP. Now, let's go to that 20-week moving average here. You can see clearly lower swing highs and lower swing lows, and we can see how. And now when we have a break above, and this was very easy to trade. Now we're back below this 20-week moving average, right? And right now, this is bearish. Bulls versus bears, we are bearish the euro. So, well, Greg, it's a weekly chart. Now, maybe if you go down to a smaller time frame, like a 1 minute, you might get a little rebound that you can trade the wick. But you're going against the current. You're going against the market tide. That's one of the biggest mistakes traders do. They go against the market tide and expecting what they're doing is they're calling it reversal. And it's not a reversal. This is like a change of the market tide. We worked down and then we rallied up, and now we're going back down again, right? So let's take a look at a daily chart. We can look back here and we can see, look, a rally up to the 20-day moving average, and we can see rejection there, and looks like we're headed lower, right? We might, and any rally against this trend, we can drop down to a 4-hour, 1 hour, and look for rallies against the trend and look at these opportunities to sell very easy. Again, this is part of the system which I teach my students in the power trading course. And the power trading course is a 6-week course which I teach and I help students. And we have a special sale going on that, Forex Foundations, right? And if you click the link that's in the description box, you can get it for $24.97. 81 videos. We have plus the members area, traders checklist, the power trade indicator template, trade spotter indicator. We're gonna have give you a Blue Guardian audition account as well. 6-week group coaching calls with myself. Usually I charge $5,000 an hour, and guess what? That's gonna be included. Plus, you can get access to 6 months of the heat map. Normally, this is $4,997, and you can get it all for just $24.97. Again, and we teach you how to trade economic news and how to set your charts up to take advantage of these massive, massive moves, right? I mean, these are just huge. So the euro, we are bulls versus bears. We are bearish on the euro, and we're looking for sells below probably at 105.05. Whole number round number 105. We start hitting the 104 area. This thing is looks to tank lower. Okay, let's go ahead and move on to the Australian dollar. I'm going to move back to my monthly chart. Actually, weekly chart. Weekly. Let's look at pound GBP USD. Stay in the European area. This is our 20-week moving average. Again, once we're above that 20-week, it's smooth sailing, and when we get below, then we start moving lower. So we're below the 20-week moving average, and we're bearish there. Let's go to daily. You see a nice rally up to this point here, up to the we rallied this high is in the 2307 area, and we've rejected that area. Big bearish candles, and usually when we get rejection from there, I mean, it goes down for several days. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 days, right? So we help our students, trade prop account. We have many people who go through our course, and our goal is to help them pass a prop account so they can get a $100,000, $200,000 prop trading account. And if they can make 10% on that per month, well, guess what? That's like, making 10% per $10,000 a month. Right, $10,000 a month, you get to keep 85 to 90% of that, and make $9,000. And usually, our trades, we trade no more than 2 hours a day, and so that's if that's something that you want to be interested in, then come over to Elite Traders University, and you want to choose to find out more. Okay, pound dollar, bearish, bulls versus bears. We are bearish on that. We might get a little bit of a rebound, we really overextended, and maybe get a little bit of a rebound so we can short it, right? But this is bearish. We wouldn't want to be buyers of this, okay? Let's look at the Australian dollar, AUDUSD. Oh, we actually could, AUDUSD. Just for time's sake, I know I would love to go over to look at the dollar Swiss, but it's probably going to be covered by dollar CAD, right? And we can see going to the 20. Looking at this is this is the Australian dollar versus the U.S. dollar. AUD USD is a currency pair, and we can see that we have been moving down from this 67 in the rejection at the 20-week moving average. We're below the 20-week moving average, but we are coming up onto some support, right? We do have this Chinese data. It can take us down. We're at 62.95 on the Australian dollar, and we have a low the low from 10/10/2022. So we're coming up on a 1-year low of 61.67. And so we could possibly make it down to that area in the next several days, right? Where momentum is moving down, lower swing highs, lower swing lows, and we have an old level of support. And this support might act like a magnet drawing price toward it. We're below this 20-week moving average. Let's look at a day. We can see we rallied up to the 20-day, and every time we've rallied to the 20-day, we've seen rejection. We've rejected hard off that 20-day exponential moving average. And it looks like we have some, well, way far more to go. Looking just at the daily, look at the 4-hour, and we similar, maybe see we got a little bit of support there, might see a little bounce, and we're looking maybe to sell any bounces in the Australian dollar. Remember, we have big Chinese news coming up, so that you want to monitor that. Okay. And then Australian dollar, let's go ahead and we can take a look at New Zealand dollar. We do have some New Zealand news. We got the New Zealand CPI coming out. It comes out at 5:45. I wouldn't necessarily want to trade it. Remove all the drawings and go over here to the weekly chart. All right. Weekly chart is kind of funky here, 20-week. We are below the 20-week, but we moved sideways for a long time, chopping around, and finally broke south. And now we just rejected the 60-31 area where this 20-period moving average here, 20-week. And so we could see, I mean, we've tried several times. It's not giving up the ghost so easily. We can draw a trend line there. CPI may give us a pop, but we need to get below this level, this trend line, and we need to get down below the support. And it's kind of janky. Like I said, we don't get below, it's still bearish. Trading against the moving average might give us a good entry. Once we break through this bulls versus bears, definitely I'm looking bearish on this as well. Okay, let's go ahead and go to the Canadian dollar. We have some Canada news coming out, and given the strength of the dollar, we can safe to assume they probably see. And now remember, USD is the same as DXY, so this is DXY CAD, right? So boom, we can see that we have been making some new highs recently. Still have in the shadow some old highs that we have, and we're above the 20-week moving average. Remember, when we get above the 20-week, this is really cool that we have this. That anytime we got below the 20-week, it provides nice entry signals to get long in the direction of the trend, and this gives a nice little entry, a bounce off the 20-week moving average. And we could probably see a couple of targets, faraway target like almost the 140 area, and then we can see maybe that the 38.59 may come into play. We're currently trading at the 136.54, right? But we have higher highs and higher lows of connected swing points, and we have an uptrend, so it's clearly up. We're avoiding taking any sells, right? And people are like, well, I think it was falling down. I broke the trend line. It's like, yeah, you just got tricked. Okay. Don't fall for the trick. Okay. Go to the daily chart, right? A lot of people that draw a trend line, they get short. Yeah, you made some pips, but guess what? This thing shot back up. And so if you did not get out and you're still holding a short, and you're still waiting for a short, you're not going to get a short. These guys are waiting for it to come back too, and it's not coming back. Why? Because we are in an uptrend, higher highs and higher lows. Bulls versus bears, dollar CAD. I am bullish dollar CAD with a target of 38.59 to 39.81 and beyond. Okay. Moving right along to our next currency. I think we pretty much covered them, but I always want to take a look at the dollar yen USDJPY. Take a quick look there, and we can see our 20-week moving average, and they're way above that. I mean, this, and now people say, well, the yen's going to strengthen. Well, there you go. That was our strength. We got below it, but then we shot right back up on the weekly and still making new highs. I'm looking for the 151 area to come back into play, the 151.94. And so we're looking good there. Let's take a look at gold. XAUUSD. Don't know why it doesn't even spell gold, but I'm sure it's a type of Latin phrase. 20-week moving average is very interesting. As long as we were below the 20-week, we were good for shorts. We got down to a low about 1809. Wow. Yeah. Back in September, October 2nd, and then we rallied back to the 20-week moving average. We didn't close above it. The geopolitical unrest in the Middle East, and also it's Diwali, or it's the season in India, wedding season, where a lot of gold actually is being used. So there's a seasonality to gold. So we got this rally, but we have a very strong, it takes a lot of force to break above a 28-week moving average. Usually it's not going to break it on one wick. And so we might see we got as high as, can you believe it? I mean, yes, we were down at the 1800s. We got as high as 1933. Happens to be the same year that gold was confiscated. So I don't know if somebody was like, hey, let's take it to 1933. Let's see if anybody remembers that U.S. government confiscated all the gold from people. Yeah. Anyway, maybe not. But I'm bearish gold, looking for a drop. Only if we got to close above this 1935 area, this little zone where it dropped, we went bottom, double bottom, failure to rally from this double bottom. See, this is a double bottom here. A lot of people were, looking at that and go, oh, this is it, guys. Bottom, drop, bottom, trend line break. People got long and then, right? And now this candle here is like we call RTTSC, a return to the scene of the crime. And so it comes back, sweeps out any orders, and then continues down, right? So I'm looking for a possible drop. As long as we stay below this trend line, okay? Now we close above it. Gold goes in the opposite direction of treasury rates, right? And we had a drop in the U.S. Treasury note, and that gave us that rally as well too. So it was a couple of things, the Indian holiday, wedding season, also the geopolitical machinations abroad, and we got a little bit of US dollar weakness. So we rally right back. So anytime we rally, people are, hey, it's 119.47, and they, right? So we rallied back up to, we rally right back into a supply zone, right? And so, we look for this wick could be a good rejection point to get short, right? And we could see maybe a retest of the 1817 area. That would be a huge opportunity to take this, right? People get baited in on that on a bull trap, and then I'm cautiously bearish. I think there's a lot of people try to push this up, but you're basically pushing a wet noodle against all of this. Right. And so bulls versus bears, I am bearish gold. Let's look at oil. Let's look at I think we can look at US oil or UK oil. What we can do here. You can look at UK oil. Right. Brent crude. And we can see we have a rally. 20-week moving average. We came down to test this 20-week moving average, haven't broke below. We broke above it, right? And so as long as we are in an uptrend, I look for this might be a good entry. We could see higher move back to the old high, 122.66 back on 6/6/2022, or we could see a wick high, extreme wick 130.134. Now, it's not the season for oil to rally. Gasoline usually rallies and going into the summer driving season, and we're switching over into distillates and things like that for the winter. But we might have, based on El Nino, we might actually have a warmer winter and might not have a big demand for oil. And if the economy is slowing down too, people might say, hey, I'll just stay and watch Netflix. I'm probably not going to go out and drive around because, gasoline is $6 a gallon. It's like, I don't think so. So even though they're also cutting production, we could have, rising prices based on a constraint on supply, but not prices rising because everybody wants oil and driving everywhere. It's like, no, right? But based on this, we're above the 20-week moving average. Using this as your kind of your thumbnail, your guide. So in case you miss bulls versus bears or something like that, put that 20-week moving average up and say, hey, I don't want to short this, right? It's above. So above the 20-week moving average, I want to go long. Below the 20-week moving average, I'm going to consider short. That's just a rule of thumb there. You can learn more rules of thumbs like that. I have more thumbs than a gorilla, right? I think they have only two anyway, right? But anyway, so oil looks bullish, bulls versus bears. Love oil. You want to see Bitcoin, BTCUSD? Interesting. And we can see that I'm going to move all these lines. We're just kind of moving sideways in a channel. And remember, we trade, it's BTC versus DXY. As long as DXY is holding strong, see, right now, we're almost like neutral. Look, we're not really above the 20-week moving average. We're not really below the 20-week moving average, right at the 20-week moving average. It was neutral. And it's moving sideways in this channel. So nothing can be really gathered from here. When the US dollar weakens, when treasury yields fall, Bitcoin kind of acts like gold, right? So even though it doesn't give a yield, the cost of holding it, there's benefit of holding it when the yields are falling, right? So Bitcoin, I am I'm neutral on this. I know it's kind of a daily chart. I mean, it's just dead in the water, right? I mean, you could trade the range. The range is 31,881 on the high side. Low side, we can move this up maybe. We get down into like the 25,000 area. We might want to look at buying support, selling resistance, playing Pong with it. If you're old enough to play the old Atari Pong game, buy bing, 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 right? And then you can break out, right? There's a game called Breakout. So anything you learn about the market, you can learn from playing an old Atari game. All right. So Bitcoin, that's kind of is pretty neutral. I want to show you the 10-year Treasury note. And I know if you watch my Facebook reel, I talked about the bonds. You probably, what's he talking about? TNX is the COB 10-year Treasury note yield. This is the yield on the 10-year note. Now, the bond note, or the note that the government issues IOUs, okay? You basically lend money to the government, and they're going to give you 5.25%, okay? And that's what they use to buy bombs and pay, national parks and, park rangers and all kinds of things, and paying your congressperson. That's all they lend. And, people buy these because, first of all, they're safe. 5.25% for doing nothing, okay, and it's guaranteed by the full faith of the United States, right? We're not the cleanest shirt in the dirty basket, but we're the cleanest. We're not the dirtiest, and we have a liquid market. That means if you had $1 billion, you can't put that in a bank. The bank would go bankrupt and say, "Hey, I'm sorry about that. It's only insured at $250,000." Banks are insured at $250,000, right? But if you bought Treasury bonds, well, guess what? That whole $1 billion you put in there, like if you're the person who won the lottery, you're just not going to deposit that in your Chase account. I wouldn't deposit anything in Chase actually. But if you had your $1 billion and if you were to put it somewhere, call me. No, I'll tell you. No, you want to buy bonds. You want to buy U.S. Treasury notes that are guaranteed by the United States government. And the United States government is probably, even though we might have a shutdown next month, it's probably not going to go bankrupt, right? And if you want to sell it, you can liquidate and get out of it very easily. So you can use the treasury, the bond, the bond market as your, well, don't other countries have bond markets? Yes, but they dwarf. They're tiny, tiny, tiny compared to the U.S. bond market. U.S. bonds control, every bond traders control the world. In fact, I live behind her. A bond trader lived behind me, and we would like look over the fence and water the lawn, talk stuff. And she was like, I said, "Oh, what do you do?" "I'm a bond trader." "What do you do?" "I'm a forex trader." "Oh, I get. Oh, the bonds control the forex and the rest of the world." It says, "You know it, don't you?" Right? It's like, yeah. It's like the bonds. They know. Look at the bonds. You know where everything is going. Right? That's why no one knows where anything is going, because no one looks at the bonds. Right? So I'm telling you, look at the bonds. So let's look at TNX. TNX. Let's take a look at the bonds. Right? Bond, James Bond, right? Look at that. This is why gold spiked, because we had a drop in yields. Yields got up to like 488, and then we dropped down to like 4.5. And if you pop gold on top of that, I'm not sure if it'll work. Let's see. Right? You can see, look at the correlation. When this dropped, gold rose. This orange line is gold. These candles is the treasury yield. When the yield dropped, gold jumped. When it's sideways, we can see that when the yield is going up, gold is going down. Similarly, will happen with Bitcoin as well. Your cryptocurrencies and your gold and your stock markets are all going to behave the same way, right? That when the yields drop, right? And if you go back in time, you can see that when we had falling yields, we had rising gold, right? And you can see that where they intersected, right? Falling yields, rising gold, right? And then when they crossed, rising yields, falling gold, right? Okay, let's look at the indices. Let's look at the SPX 500, and then we'll wrap things up. Hope you guys are finding this useful, helpful. I don't see a chat box. Let me get rid of the gold here. I don't know why it doesn't show up. I like to interface with you guys, but so here's we're going to go to the SPX 500. We look at CFD, and you can see that as long as we were above the 20-week moving average, it was on and cracking, baby. Boom, right? Then we made a lower high, a lower low, a break in structure, right? There you go. For those structure people. And then now we're below the 20-week moving average, and this is bearish. We're bulls versus bears. We are bearish on the S&P 500, and you can see that we're rallied up to there, up to the 20-day moving average, and usually every time we rally near it or around it, prices drop. So it'll be very interesting. As long as we don't break above 43.97, you might see 41.99, right? We might see this a continuation trade, right? And we had non-farm payroll, and it was much stronger than expected, and so that was going to be bullish on, the Fed's going to remain higher for longer, right? SPX 500, we can see bearish, bulls versus bears, bearish. We can take a look at the NASDAQ 100. I'm going to use NDQ 100, something like that. All right, we can do that. And now this is interesting. Oh, no, it's not. Weekly. There we go. See, it is interesting. This is very interesting, right? We're at on the NQ, we are right at above the 20-week moving average. So it slightly has a bullish tone. And NQ had, the NASDAQ had a bullish tone over all the others. Why? It's very tech heavy, and we had tweezer bottoms below, and now we're rallying. And so maybe this is, I'm actually bullish. And then here, the 20-day, we're bullish, but it's interesting how he dropped and rallied above it, and we have maybe a double bottom here, perhaps, right? A shades of gray double bottom, right? But this thing we've seen where it just falls off the shelf, right? where we could be it could actually lag. Is it lagging or is it forecasting? That's what we don't know, right? I mean, I see a trend, higher highs and higher lows, and I have to go to a 4-hour chart, but this sell-off is very vicious and wicked down. If we take this trend line, can I get the trend line? Yeah, like that. So we have 2 points make a line, and we don't have confirmation that this line is going to hold or a bounce, right? If we get a bounce and a retest and it holds, then this could be the very beginning of a new rally, bull rally. But right now, this thing could break right through and keep on going, right? So we're at a critical area. We're bullish if it bounces and bearish if it breaks below 14,928. I have a feeling that we might get some type of at least a 50% bounce. You take that swing high to the low, look for maybe about a 38% bounce to 15,008. So we can see some type of a temporary bounce before a retest of the line, which would be profitable for the bulls short term. If we could find an arrow, yeah. I would look for a bounce. And if that bounce fails and, they want to take a test of that line could break. They'll give us a little kind of a head and shoulders on this, right? So I'm short-term bullish and medium-term, I'm slightly bearish, right? So that's it for that. Okay. So that's going to be it for Bulls versus Bears Weekly Forex Forecast. Again, I want to thank you for watching, and remember to come up and visit us at EliteTradersUniversity.com. We have lots of materials that can help you. We have an income boost blueprint ebook that you can download. Okay, we won't spam you. You probably say, well, where is he? He doesn't even email us. Like, I'll email you once in a while, right? But there's also a free masterclass you can sign up to, 4 Pillars to 6 Figures. You can just go as 4 Pillars for on-demand trading, profits, and financial freedom in 8 weeks or less. Even if you've never traded before, you can click this and register and watch the video, learn about how the pip and run system actually works. You can also check out our sale on our course that's there for a limited time only. And, with that said, thank you so much. I'll talk to you really soon. Peace and pips. Dr. Greg signing out.